So good morning, everyone. Thanks a lot for inviting me to this roundtable. It's a great pleasure to be here. So as you can see from the title, there will be some overlap with what Michael said, but I think there will also be something new, so bear with me. Okay, so while thinking about the connection between industrial policies and global imbalances, because some major surplus countries are indeed running big industrial policy programs. Think about China. So as you all know, right now China is running a very large surplus. For instance, if you look at the trade surplus in manufactured goods, Chinese surplus stands at 2% of global GDP right now, which is a huge number. And of course, China is also a very big player in industrial policy. It's the biggest investors in industrial policy. Now, during these remarks, I will focus on three questions. First, through which channel industrial policy shape global imbalances? What are the spillovers that deficit countries experience? And which policy responses this deficit country can put in place? And in doing so, I will take a particular perspective. So I will focus on the impact of global imbalances on the geographical distribution of innovation activities and technological hegemony. And in doing so, I will draw on these two recent papers that I work with a fantastic team of co-authors. Okay, to start, let me introduce a simple conceptual framework. Now, in the paper, you can find a fully fledged model. Here, let me just sketch what the framework is about. So think about a global economy composed of two regions, East and West. And each region produces two goods, a tradable good, which is going to be the engine of growth. It's going to be the sector in which innovation activity takes place. Because in the end, high-tech goods and high-tech services are highly traded in the global economy. Instead, the non-tradable sector is going to be a sector characterized by stagnant productivity. Think about construction, low-tech services, and so on. So the first feature of the model is that a country featuring a larger tradable sector, a more competitive tradable sector, will also be a country in which the return to innovation is high, and so in which productivity will tend to be high. And that's what the blue line in this diagram is capturing. At the same time, as in standard endogenous growth model, a country that invests a lot in innovation and in the adoption of new technologies will have less resources to produce, and that's what the red line is capturing. So this diagram is giving you the equilibrium in the market for innovation and production of tradable goods. The second key feature of the model is that global imbalances, so international capital flows, are determined by the demand and supply for liquid assets. And here, let me make things very simple. Imagine the household need to hold liquid assets to insure against idiosyncratic risk or to perform transactions. Naturally, their demand for this asset will be increasing in the interest rate, so in the world interest rate, and that's what the upward slope blue line in this diagram is capturing. Who supplies liquid assets? Well, the government. So think about the stock of liquid assets as the stock of public debt, net of foreign exchange reserves. And to make things simple, let me assume that this stock is constant. That's what the red line, the vertical red line, is capturing in this diagram. Now let's think about an experiment. Let's imagine that suddenly the East government starts running an industrial policy program. It starts subsidizing its tradable sector in an attempt to foster high-tech activities. So naturally, subsidizing the tradable sector will lead to an expansion in tradable activities and a contraction in the non-tradable sector. So the red line shifts in the left diagram. Moreover, in this framework, since innovation are driven by the tradable sector, a larger tradable sector will induce firms to invest more in innovation, and so productivity in the East will rise over time. So as time goes by, this industrial policy will boost income in the East. What about capital flows? Now, here many things can happen, but let me think about a particular scenario. So since national income in the East has risen, also household demand for assets, for liquid assets, will go up, right? So that's captured by the downward shift of the blue line on the right diagram. Now, it could be that the East government could respond to this increasing demand by liquid assets by increasing the supply. But let's think about a case in which this doesn't happen. Let's imagine a case in which the East government maintains the supply of liquid assets fixed. Then what will happen is that this high demand for liquid assets by its household will be satisfied through the purchase of foreign assets, so the East will experience capital flows. Or to say it differently, this is a case in which the industrial policy mix is unbalanced. So it leads to a rise in national output, which is not matched by a comparable rise in national consumption. So it results naturally into trade surpluses. Now, what I'm interested in is on the spillover toward the West economy, toward the rest of the world. So, well, the first leg of the spillover is pretty standard. So high saving supply by the East will induce a drop in the world interest rate. And households in the West, facing a cheaper borrowing condition, will borrow more, and so the West will develop the capital inflows and trade deficit. Now, the interesting part, what is going to happen with these capital inflows and this trade deficit? Well, West households are going to use these capital inflows, this cheap credit coming from abroad, to consume more. Higher demand for consumption by West households will lead to an expansion in the non-tradable sector. Think about construction, think about low-tech services. In turn, this expansion in demand for locally produced goods will drive up the exchange rate. So the West real exchange rate will appreciate. And this will make the tradable sector in the West less competitive, and so the tradable sector in the West will contract. So that's the leftward shift of the red line in the left diagram. But that's not the end of the story, because as the tradable sector in the West contract, there's going to be less incentive for West firms to invest in innovation. So over time, as innovation activities in the West decline, also productivity in the West will slow down. So here in this simple framework, trade deficit over time lead to a decline in national income by hindering innovation activities and so productivity growth. And you can think of this process as a financial resource curse, because if you think about it, it's similar to a natural resource curse. You know, the idea that if you discover, say, oil, your exchange rate is going to appreciate, and that's going to crowd out manufacturing activities. But here, the West has not discovered any natural resources. It has access to cheap capital inflows. So that's why you can think about it as a financial resource curse. So essentially, you know, in this simple framework, industrial policies and global imbalances shift the geographical pattern of innovation and technological power. This is just a simple simulation which shows you what happens when the East implements some unbalanced industrial policy, leading to higher investment in the tradable sector and trade surpluses. The West, the solid blue line, will experience in response a stream of trade deficit, lower innovation activity, so a period of subpar productivity growth, and this will translate over time into lower GDP in the West. So what's interesting when you look at this diagram is the timing dimension. So global imbalances might not have a strong impact on productivity immediately, but over time, as they affect innovation activities, they can lead to big divergence in national income. Now, is there something of this story in the data? I wish I could show you some cleanly identified natural experiments. I don't have them, so I will rely on some simple correlation. So in this paper, we look, for instance, at the correlation across countries between the use of industrial policy and the behavior of the tradable sector, proxied by manufacturing, it's the left diagram, and TFP growth as a proxy for productivity growth. And what we can see is that over the last 20 years, those countries which implemented industrial policy most aggressively also experienced largest increases or smaller shrinkages or their manufacturing activity and faster TFP growth. And here, of course, the countries dominating the correlation are East Asian economies, China, the Philippines, Korea, and so on. What about the reverse mechanism? What about the financial resource curse? Do we have some evidence in favor of that? So here I think that we are standing on solid ground, because even though, we don't have causally identified empirical evidence, the correlation is pretty robust. So we know that even during the long run, or if you look at time series evidence, countries that experience persistent stream of trade deficit also tend to experience shrinkages in their tradable sector and slow down in productivity growth. Here, I'm showing you, by doing the following experiment, I'm plotting episodes of large capital inflows, so episodes in which a country suddenly ran a trade deficit in excess of 4 or 5% of GDP. And what you can see is that during these episodes, productivity growth slows down and manufacturing share of the economy tend to shrink. So this is consistent with the key mechanism of the model. Now, should the West worry about these dynamics? So does the West suffer in welfare terms from this financial resource curse? So this is not obvious, right? Because in the end, the West is importing cheap capital from abroad, is importing cheap goods from abroad. This boosts consumption. So in principle, these dynamics could be good in welfare terms. That is, the tradable sector in the West might end up shrinking, but household welfare might end up going up because they consume more. However, think about the fact that investment in innovation is a type of investment which tend to generate a lot of externalities, a lot of positive spillover. It's a type of investment in which the social return tend to exceed the private one. So we think that in our economies, firms underinvest in innovation. And what's happening in this model is that unregulated capital inflows exacerbate this tendency to underinvest in innovation. And if this effect is strong enough, the hit that the economy is going to take in terms of lower national income might overturn the gains from higher consumption on impact. Moreover, again, the timing dimension might matter. So here, trade deficit might boost consumption in the short run, but lower it in the medium run once the impact of capital inflows on innovation activity materializes. So countries running trade deficit might have to worry, and might have to worry because of what will happen in the future, because the process of deindustrialization and lower innovation and slowdown in productivity growth might hit welfare down the line at 5-10 years horizon. Moreover, high-tech sectors are key for national security, at least some of them. So also in periods of geopolitical tension, it might be a good idea to keep an eye on economic activity in high-tech sectors. So what can the West do? There are two types of policy options. First, the West might try to reduce global imbalances. It might put in place policy that tend to reduce the trade deficit, because that's a way to sustain economic activity in the tradable sector and so innovation. So one possibility is to impose broad-based import tariff. But we know that this type of instrument is very blunt if what you want to address are net trade flows, because tariffs are good to reduce gross trade flows, less tailored to net trade flows. Moreover, if a country's objective is to sustain innovation activities, very broad-based tariff might backfire, because they might put restriction on imports of innovation inputs from abroad. Think about, computers, critical mineral. So they might even lead to a slowdown in innovation activity. Another possibility is to implement policies that boost national savings, because in the end, the reason why the West is running a trade deficit is because its policy framework is keeping national saving low. So this policy could be fiscal tightenings or macroprudential policies aiming at reducing private borrowing from households. So at least in theory, this policy should work at addressing the trade deficit. However, they also tend to depress global aggregate demand. So if these type of policies are implemented by large countries, say the US and the European Union contemporaneously, they might risk to generate a global economic slump. Moreover, in the end, in the story that I told you, global imbalances are not a problem per se. They are insofar as they lead to a decline in investment in innovation, in productive investment. So, and they do so because they lead to a reallocation of credit and economic activity out of the productive tradable sector and toward the unproductive non-tradable one. So if the objective is to fight these dynamics, perhaps the right policy tools are more tailored. They're innovation policies such as subsidizing R&D, increasing spending in basic public R&D, or running industrial policies that are going to boost innovation activities. And this type of policy might reconcile trade deficit and capital inflows with a healthy tradable sector and healthy investment in innovation by redirecting credit out of unproductive non-tradable sector toward productive tradable one. So as to say, if the problem is that trade deficits hurt innovation, perhaps you don't want to reduce the overall trade deficit, you want to redirect the capital inflows toward productive investment. And to conclude, one last thought. So perhaps again, if the idea is to protect the high-tech sector of the economy, tariff might have a place in the policy toolkit, but targeted tariff that protects some specific sector, some key high-tech sector that we think are key to national security or to the innovation system. Okay, I will conclude here.
So Luca covered quite extensively on the industrial policy on the production side. Next, we have Bruno to address portfolio financial flow on the financial side, which is a flip side of trade imbalance.
All right, thanks a lot for the invitation. So again, my remarks will sort of provide a little bit of the the financial counterpart to some points made by Michael and by Luca. And so the title of my presentation is Finance Across Borders, a Spatial Economics Approach. And I want to start my remarks with a graph. So this comes from a paper that we published last year in the Quarterly Journal of Economics with Enrico Spolore and Romain Baxiag. And what basically you're looking at is basically a map of the global spatial allocation of capital. It's a map, so every dot in this picture is the geographic epicenter of a country, and these red threads represent the intensity of investment between different countries. So basically, the reason I chose to start with these images is sort of it's like a visual summary of what has been a big part of my research agenda over the last few years. Basically, a lot of my work has been focused on trying to understand the structure of this network. Why does capital flow from specific countries to specific other countries? Why and what leads to changes in this network of investment over time? And so basically, what I want to do today, I want to tell you a little bit about what we learned from this research agenda. And also, very briefly at the end, I'm going to touch a little bit on what that might imply for current events. Okay, so basically, the first paper in this agenda, the one with Enrico Spolore and Baxiag, we develop a dynamic spatial model of international capital allocation. It's an economic model that tries to explain, again, why do some countries have a lot of capital with respect to others? Why do the rates of return to capital differ across different countries? And I'm not, of course, I'm not going to present the entire model. I'm just going to give you a few, the essential elements of the model. And so basically, the model is going to have a bunch of countries. The countries in the model are actually real countries. So it's a fully structural model. And each of these countries is populated by a representative firm that produces some tradable good, let's call it GDP, using three inputs: labor, natural resources, and capital, okay? Now, these representative firms are going to issue shares, and these shares can be bought by international investors, and these shares entitle investors who buy them to a share of these representative firms' profits, okay? Or in this case, the profits is the capital income share. And now, at the same time, in each of these countries, there's going to be a bunch of households, and these households are going to earn income from these three factors, and they're going to face basically an intertemporal budget decision. They're going to have to choose how to allocate their income between consumption and savings. And then there's going to be a financial intermediary that is going to allocate their savings across different destination countries. It's going to form portfolios of the shares issued by firms in different destination countries. Now, how these portfolios are formed, how much investment flows to each destination country depends on a number of stuff. It depends on the marginal product of capital in each destination country. This is an endogenous object in our model. And then it depends on, informally speaking, on the fundamental riskiness of the destination country. So you want to invest more in countries where capital is productive. You want to invest less in countries that have, for example, very volatile business cycle, countries that where this return is risky. And a third important factor affecting the formation of international portfolios is barriers to international investment. So you might face some significant impediments to invest in certain destination country, and that also affects international portfolios. Now, let me give you a simple diagram that explains in some sense how this model reaches its equilibrium. So in this diagram here, you have on the horizontal axis KIT. This is the capital stock of destination country I at time t. And on the vertical axis, you have RIT. This is the rate of return on capital in the destination country I. And so you have this downward sloping blue curve is the rate of return on capital schedule, and because there are immobile factors, it's decreasing. So the more you invest in a certain destination country, the lower the rate of return. Then there is a supply function for capital that comes from international investors. I drew two of them. The one in green, in some sense, represents a situation where the supply is strong. So international supply of capital to a destination country is strong because it might either be that international investors perceive the destination country as low risk, or because they face few impediments to invest in the country. Another reason it could be that basically in other countries, risk is high and barrier to investment is high. So the strength of the supply also depends on what's going on in other countries. So like in the previous paper, there are international spillovers, okay? And instead, the red line shows you a situation where the supply is weak, again, because relative to other countries, the destination country is high risk, or there are high barriers to investment. Now, in the first situation, we're going to have an equilibrium, let's say a good equilibrium for the destination country, where investment is high and the rate of return on capital, or if you prefer, the cost of capital for the firm that operates in that country is low. Okay. Instead, when the supply is weak, we're going to have an equilibrium with low investment and a high rate of return that is a high cost of capital, okay? And so basically, there's two big reasons in the model why a country may have low investment, high rate of return on capital. It could be either due to riskiness of the business cycle in that country with respect to other countries, or because there are significant barriers to investment. Now, what we do in the paper is we go and basically measure a bunch of variables that captures the difficulty to investing internationally. So we capture stuff such as political risk, international taxes. Another important factors affecting international investment is information frictions, which we proxy with a bunch of geographic, linguistic, and cultural variables. Importantly, I didn't mention capital controls. That's by design. Part of the point we're trying to make in this paper is that there's a lot of other stuff that goes on in the in a certain country's macroeconomy that affect its attractiveness to international investors that doesn't have to do necessarily with capital account management. And so what we do is when we take the model to the data, we power it with these frictions, we find that it explains a remarkable amount of features of the data. So for example, one thing that you see in the data is that low-income countries have higher rate of return on capital, and basically in particular, it's higher in such a way that is not explained by riskiness alone. Our model, thanks to these additional barriers to international investment, is actually able to rationalize this negative relationship that we see in the data. So our model captures quite well this negative relationship between the level of income, so here you have log GDP per employee, and the rate of return on capital. Another thing that we do with the model in the paper, we can basically do simulations. We can basically simulate what if we were to remove all of these barriers to international investment, what will happen to the spatial allocation of capital. So here you can see in this diagram the distribution of capital across countries. The light blue area represents the observed world where we have all of these distortions, all of these barriers. When we remove barriers to international investment, that's the red dotted line, we get basically a much more uniform allocation of capital. A lot of the cross-country inequality in capital per employee goes away, and actually world GDP improves. Now, there's a follow-up paper with Damien Capel from the International Monetary Fund, where we use basically the same model, but we basically want to take more of a retrospective view on financial globalization. So we want to use the model to analyze the last 5 decades of financial globalization. And so again, this paper builds on the idea that there are many factors that affect a country's financial openness, that is, a country's ability to attract and retain capital. And in particular, if you want to go and look back at the 70s, there's basically no hard data on that. So how can we possibly study this? Basically, remember how in the previous paper, we measured the frictions and then we let the model predict what the data should look like, the international investment, the rates of return. Here we do the opposite. We start from the data, and through the model, we reverse engineer what frictions, what barriers will explain the patterns in international investment we do in the data. So for each country, we recover these measures of revealed financial openness, two numbers for each country that capture how easy it is to invest from the country outside for the rest of the world and from the rest of the world to the destination country. So here one means fully open. So let me show you what we find. We basically documented this new stylized fact that we call unbalanced financial globalization. So what I'm showing you here is these measures of revealed financial openness for two groups of countries. Here we're just looking at high income and low income. there's 4 lines here. So the 2 bottom lines, these solid lines are low-income countries, okay? The dotted lines above are high-income countries. Light blue is the outward openness of a country, so how easy it is for capital to escape the country. Dark blue is the inward openness. And so what you see basically is that already back in the 70s, high-income countries were much more financially open de facto. Over time, they became even more open, but in particular, they became more inwardly open. So the ability of high-income countries to attract and retain, to attract capital improved. For low-income countries, basically, almost nothing happened to their inward openness, their ability to attract capital. Instead, their outward openness increased. So now capital escapes low-income countries much more easily, okay? So this is what we call unbalanced financial globalization. The consequence is that this unbalanced financial globalization, again, we can do this, you can measure this in the day, thanks to the model, lowered actually world GDP. It led to a cross-country misallocation of capital that costs about 6% of world GDP. The idea is that the countries that they received more capital were countries that already had too much capital to begin with, where the rate of return on capital was low, okay? And so the other consequence is that this increased cross-country inequality. Again, capital flew from where it was already scarce to where it was already abundant, and this in turn lowered wages and increased the cost of capital in low-income countries. So again, this is the other thing that we can do with the model. We can simulate what would have happened if globalization had been balanced, meaning if all countries had opened up financially at the same pace and in the same direction, and the exact opposite would have happened. World GDP would have been higher, and in cross-country inequality would have been lower. Okay, I was going to talk about the relevance for current events, but I feel like we're going to have plenty of time for that in the Q&A. So let me quickly conclude. And again, thanks a lot.
Karsten actually was here in the JRC as a postdoc until he moved to NUS as a faculty. So Karsten will share thoughts about work about global credit flow.
Okay, wonderful. Thank you so very much for inviting me to this illustrious event. As Wei kindly pointed out, I've had the privilege of spending almost 3 years here at the Julis-Rabinowitz Center. So it's an absolute pleasure to be invited back and share a couple of thoughts. So, a lot of, I think, our kind of discussions that we've had today and also yesterday are really motivated by this observation that there's a bit of a dichotomy when we think about the role of finance in the real economy, right? So on one hand, we know that capital inflows and large expansions in credit, they often precede some kind of financial crisis or deep economic recessions. But we shouldn't forget that, on the other hand, of course, finance plays a really important role, credit provision in particular, when we're thinking about episodes of economic growth and economic development. And so what I would like to argue to you today is that the sectoral allocation of credit, so understanding where in the economy is it that credit is flowing, is really critical for understanding when should we think of finance as a kind of potential vulnerability or creative vulnerability in the economy, and when is it something that is conducive to economic growth. And so here, I would particularly like to emphasize the role of industrial or credit policy, as we've already, heard in a couple of our talks this morning, because I think this is an extremely important lever for thinking about where is credit flowing. And so the question is, we already know countries are doing this. We already know that they can do it. So the question is, should that be done much more aggressively? Should we really think of the sectoral allocation of credit as a policy variable? So to get started, I would love to share a couple of observations that are just really facts about the allocation of credit in the economy to make sure we're kind of all starting from the same point here. So over the past 5 or 6 decades, we've seen this secular increase in the kind of ratio of credit to the private sector relative to GDP. You can see this here on the left-hand side. This is based on joint work with my co-author Emil Werner, who is sitting here in the front row. Now, many have highlighted that, a lot of this increase in credit to the private sector is actually household debt. So you can see this here on the left-hand side. This kind of dark blue shaded portion reflects the increase of household debt. But I think a much more interesting, to me at least, and much more striking fact is actually on the kind of sectoral allocation within the corporate sector, which is unfortunately not showing up on my slides. So I'll just tell you in words. So, what we've seen over the past 30 or so years is that banks really used to lend predominantly to the manufacturing sector. So you go to the 1950s or 60s, what banks were doing is 50 or 60% of the loan portfolio goes to manufacturing, and really a negligible part goes to, say, construction and real estate. Today, we're really seeing the opposite pattern. So in many countries, credit to the construction real estate sector is perhaps 25 or 30% of the loan portfolio. If you look at the Netherlands, for example, half of all credit actually flows to construction and real estate. So there's a large industrial shift in the composition of credit. Now, we also see this, that this is not just a reflection of kind of underlying structural change in the real economy. So this is also from joint work with Emil and Paul Dye, who's a PhD student at MIT. So what I'm showing you here is kind of the level of a country's development on the x-axis. On the y-axis, you see the share of credit, value added, and employment that the manufacturing sector accounts for. And so basically what you see is first, and this has been widely documented, that, the real economy undergoes this kind of structural change where, first, as you get richer, the share of the manufacturing sector increases. Then at some point, you really, you kind of go towards services and it then decreases. But for credit, this is kind of much more pronounced. So if you're quite poor, then a lot of your credit goes to the manufacturing sector, and that just kind of falls off a cliff as you become richer. Now, again, I can't show you this because the animation is not showing here. But for real estate, you see the exact flip side. So, when countries are fairly poor, they do very little credit provision to construction and real estate. And as they get richer, credit really just increases almost exponentially in a way that's really not accounted for by movements in the real economy. Now, so this kind of brings us to the question, okay, why should we care about this allocation of credit? And so kind of one way of thinking about it is to ask the question, well, what is it when we look at episodes where things go really badly, we look at major financial crises, what is it that happened to the sectoral allocation of credit before? And so here I want to make kind of one example. I want to show you something about the Spanish crisis of 2008 that kind of preceded the sovereign debt crisis in Europe. And so what you can see is that Spain underwent a really major expansion in credit in the 2000s, but really this expansion of credit was incredibly lopsided. It wasn't that credit was flowing to all sectors in equal manner. In fact, if you look at the bottom here, the manufacturing sector really barely received any credit during this time period. What happened was that almost all of this credit provision went to real estate developers, it went to construction companies, to households, and to other types of non-tradable services that, as we've heard a while ago, you could want to think about this as kind of, supermarkets, shopping malls, right, and kind of local restaurants. So kind of low-tech services, as Luca called them in his presentation. Now, this is really a common pattern. I had here a picture of the Japanese financial crisis of 1991, and you would see a very similar pattern in many emerging market and advanced economy crises. So this is not limited to the European experience. Now, this is really a part of a much more general pattern. So, whenever you see that there's an expansion of credit to the non-tradable sector, it tends to be very much predictive of kind of disappointed growth outcomes in the following years. So you can see this here on the left-hand side where you see, kind of a local projection showing, more credit flowing to non-tradables tends to precede recessions. If I draw the exact same graph, but for the tradable sector, you will again see the opposite pattern. So more credit flowing to the tradable sector kind of forecasts, in a sense, an economic expansion rather than a contraction. Now, we've heard, a little bit about household debt, and so I just want to make a small point here on financial crises in particular. So there are really bad types of events associated with credit booms. So I think one thing that's important to realize is that when we're talking about a financial crisis, it's really kind of a debt crisis. And so what makes it a crisis is that someone is defaulting and someone else doesn't have enough resources to kind of shoulder those losses. So that then raises the question, okay, who is actually defaulting during financial crises. And this here is based on joint work with Shebnem Kalamli-Özkan, Luke Levin, and Victoria Bashina. So, what you can see here is that during a typical financial crisis, firms actually kind of account for the vast majority of the non-performing loans on bank balance sheets. And so, one of the obvious reasons for that is just, you're kind of defaulting if you're allowed to. And in most countries, the bankruptcy framework allows firms to get debt written off, but not households, where there's a really important exception here, which is the United States in 2007. So I want you to think of this as that a lot of this relation between credit expansions and really bad crashes actually works to kind of the corporate sector. Now, I've said some things about, economic troubles that are associated with credit, but of course, credit provision is really critical also for understanding periods of economic takeoff. And so here, Michael very rightly pointed to the Korean experience before, which is actually quite instructive because after General Park's takeover in the 1960s, they basically took over the banking sector entirely and started commanding the banks to lend to the manufacturing sector. And so, they were commanded to lend to manufacturing, and lending to manufacturing they did. During the 1960s and 70s, Korea experiences a massive expansion of manufacturing credit, not much of a change in other types of credit. And of course, that preceded what we today call the Korean growth miracle. Now, this is a much broader pattern that we see in the data. So, when you look at what is the share of a country's credit market that is aimed towards the manufacturing sector, that is very positively correlated with higher economic growth over the next 5 or 10 or 15 years. Now, if I again drew the exact same plot here for the real estate sector, you would see the exact opposite pattern. So, the more a country relies on lending to construction real estate firms, the lower its growth rate over the next 5, 10, or 15 years. And so this brings me kind of to the last part of my talk, which is, so what is it that explains where all this credit is flowing? And so, here I kind of want to divide up the discussion a little bit into an international dimension, so which countries are receiving credit, and a sectoral dimension, so which sector is it that receives credit? And of course, these are very closely linked together, but I think it's still useful for the kind of presentation purposes to think about these separately. So let me start here with the international margin. So we know from much existing work, including Luca's, or here another paper by Julis-Rabinowitz, that capital inflow episodes are actually quite important for understanding this sectoral allocation. So here you can see during a large capital inflow episode, the non-tradable sector tends to expand much more than the tradable sector. And you would see the same thing if you're looking not at output as Imbalances does here, but you look at credit. Now, what I think is really critical is that a lot of these capital flows we're observing are not actually kind of the outcome of just, market participants waking up one day and deciding, look, I want to give a lot of money to this country, but it's instead government action. And it's government action through industrial policy. So, if we look at what is actually the most widely used tool of industrial policy today, it is what is usually called export credits. So export credits mean I'm a Korean manufacturer. I would like to send a machine or sell a machine to an Angolan importer. And then to sweeten the deal or to make sure that transaction takes place in the first place, I'm going to ask the Korean Export-Import Bank to kind of guarantee this transaction. So it's essentially government-backed loans to foreign buyers in support of the domestic exporters. And so if you look at what is it that actually accounts for a lot of the debt of low-income countries, so especially here cross-border loans, you can see that around 70% of cross-border loans to poor countries is actually the industrial policy of richer countries. Okay, it is exactly this kind of export credit that accounts for a lot of this debt, and we also find pretty sizable magnitudes for emerging economies, and this is based on a paper with Adrian Matre, Chenzi Xu, and Zekai Shen. Now, I've said something about the international dimension. Now, what about the sectors? Why is it that some sectors sometimes receive more credit than others? Now, one hypothesis you might have is to say, look, this is really just about some technological development, right? It has nothing to do with policy. Maybe this is kind of a kind of law of nature, if you will. And so one way to think about this is, to look at how has the economy changed in terms of the share of intangible assets. And so here, one example of a technological change that I think is interesting is as countries get richer, they rely increasingly on intangible assets. But actually, this matters most for the manufacturing sector. So, think about this. I'm a real estate developer in a poor country or a rich country. What is it that I'm doing? I'm using cranes and cement, right? I'm not going to change my fundamental production function in some sense. But for manufacturing firms, there's this really striking increase in the reliance of intangibles as countries get richer. So if we think intangible assets maybe make for bad collateral, then that could be a technological explanation for why is it that credit in richer countries is flowing away from manufacturing and towards real estate. But I would like to say that, really even when we think about the sectoral allocation of credit within a given country, it's really critical to think about industrial policy or credit policy, as it's called in many places. And so, together with Emil and Paul in our paper, we've looked at episodes, when is it that countries basically stop forcing the banks to lend to manufacturing, which is usually called directed credit episodes, so something that is still very much done, for example, in China today. And what we see is, as soon as countries basically, stop this kind of directed credit, what happens is credit flows away from manufacturing and it flows towards real estate. So, again, in some sense, when we're thinking about why is it that credit sometimes flows to, let's say, higher productivity purposes, right, or high innovative purposes, as Luca was emphasizing, and why is it sometimes flowing to construction and real estate, and we have these kind of crises, a lot of it is really just the result of industrial policies. So to conclude, my argument is that when we're thinking about cross-country capital flows, cross-border credit, when we're thinking about the allocation of credit in the economy, when we're thinking about industrial policy, these are really kind of intrinsically linked together. I think there's a lot of important open questions that also, were coming up today in the discussion. But, my key takeaway, even from just the existing evidence we already have, is, the sectoral allocation of credit, where credit is flowing, is already a key policy variable in countries such as China. It's been extremely widely used in many countries as the policy framework for both industrial and monetary policy in the past. And so at the very least, I would say, if you're a policymaker, you ignore this at your own risk. So thank you very much.
Okay. Actually, I want to use my own privilege first. First, let me start with Michael. A fantastic speech. You covered the many grounds on China and the global consequences, imbalances. Actually, I'm writing a book about Chinese economy. I think I'm very sympathetic to hear your insight about the structural imbalances in China. I have lots of questions for you, but maybe later. So I want to sort of connect this with the rest, because I think sort of the three panelists follow up. They actually, their presentation connects very well with your earlier speech. I think sort of Luca's model kind of highlights sort of a key point that you want to highlight, right? So when there's one country using industrial policy heavily and have an internal imbalance, this spill over into the rest. I guess sort of in terms of trade, typically in the standard model, we think about the comparative advantages, right? So of course, so the rest of the world benefit from these trades, right? At least on average. Otherwise, they wouldn't be trade. Nobody forces other country to trade, right? Luca used this word. This is the first time I hear. I think a very interesting financial resource curse, right? So this is a new curse. I think it's quite interesting. So on this, I suppose sort of this kind of frame U.S. like a victim here, but of course U.S. benefit tremendous from this as well, right? So nobody mentioned AI, so right? So U.S. Is the driver of all this innovation, creative destruction. I think potentially, in large extent, financed by the financial resource curse, right? Because all this low interest, Wall Street finance trillions of dollars into this AI, and now I think it's sort of is taking over, right? So what about this side? The U.S. clearly gained a lot from it, right? So and still is dominating everybody will agree this is the future. So in that sense, sort of what about this side, right? So in that sense, shouldn't this reflect the other side, that there would be imbalance on the U.S. side as well? right? So there will be imbalance on China, Korea, sort of when they use industrial policy, right, to address their issue. So then it's really sort of whatever trouble, the spillover, also sort of there's sort of systematic issue on the receiving end. So maybe start with Michael.
Yeah, is this on? I'm not really sure. Yeah. What I would argue, and what I used to teach in my class, is that you can't really talk about whether countries benefit or lose out on these imbalances. It makes much more sense to talk about different sectors that benefit and different sectors that lose out. So I would say the current system really favors certain sectors within the U.S. economy. And here I feel like a traitor to my class. I spent many years running fixed income trading and capital markets on Wall Street. And I would say one of the great beneficiaries of this system is precisely Wall Street, owners of movable capital, because when you have very, very low frictional costs, it's very easy to move capital to wherever, not necessarily where it's most productive, but where it's most profitable, and those aren't the same things. I would argue that perhaps the foreign affairs establishment also benefits tremendously from these imbalances because of the ability to impose sanctions. I would argue that manufacturers are clear losers, workers are clear losers because of downward pressure on wages. It's not exactly a secret that even in countries with relatively high wages since the 1980s, wages have not risen as quickly as productivity, which is a big problem. I would argue middle-class savers are losers. The farm sector are losers. So it really depends. And I think that's why it's so very hard to resolve it. Because whereas most Americans would say, you know, Wall Street, factories and workers, we'll go with factories and workers. The fact is that Wall Street is much, much better at making its case, to put it politely, than factories and workers. But yeah, I would really think in terms of sectors. Even China, right? It's not that China benefits. Certain sectors within China benefits from these imbalances. If you're a Chinese worker, it's often hard to see what the benefits are.
Thanks. Luca, do you want to?
Yeah, if I may add. So, I mean, of course, there are many determinants of innovation and technological development, and global imbalances are not probably the major one. So the question is the US technologically advanced in AI because of capital flows or in spite of large capital inflows? And the other point that I wanted to make is that, in my view, global imbalances are not a problem for innovation per se. So running a trade deficit doesn't necessarily have to lead to lower innovation and lower technological development. But if you use a little bit of macro theory, you see that unregulated capital inflows, unregulated trade deficits are likely to do so because they're likely to boost, as Karsten was showing us, credit in construction and other non-tradable activities. So to me, you know, trade deficit and capital inflows are not necessarily a problem as long as we implement policies that direct this credit toward promising high-tech sectors, which tend to be in the tradable sector.
Right. So in that sense, sort of, you know, the problem is not this per se, but really sort of some policy to redistribute, trying to allocate this more, there's still gain there, right? So really it's about the sort of follow up on Michael's comment about, well, maybe there'll be, if there's some kind of redistribution to cover manufacturing in the US to subsidize, right? So that would be ultimately the solution to, I mean, to still maintain comparative advantages and to provide some assurance, right? So let me, for Bruno, so the capital flow pattern you mentioned really is the flip side of the trade imbalance, right? For this low-income country, because most of them end up in manufacturing, so there's a trade surplus, of course, that end up being the capital outflow, right? So you attribute this to sort of to riskiness in the investment in those countries and to some extent financial friction, I would say, right? So then it's really sort of echo your presentation with Michael and Luca. So is this I guess this is sort of causal. Is it really because of a riskiness and a financial friction, or is it because of a structural imbalance? This country, by design, they want to run trade surplus rather than, right? So because as long as they have trade surplus, you are going to see capital outflow, right?
So, no, thanks a lot for giving me the opportunity to clarify this point, because obviously the presentation, I had to simplify a lot. But so no, the answer is that, these imbalances are not just driven by, financing friction. So there is basically the capital account imbalances and the trade imbalance are co-determined at the same time. So a different way, maybe a more nuanced view to say the model. The model has, in some sense, has a very strong emphasis on the role of financial frictions. But really what's happening in the model is that the countries are sorting themselves. So the model actually, in its steady state, it actually produces sustained global imbalance. They just continue on forever. How is that possible? One way you can think about is that countries sort themselves basically into producers and savers. So in some sense, there is a certain country that in equilibrium basically specializes in the provision of producing goods. Basically, these are like the countries that do a lot of manufacturing. And some other countries instead, they specialize in becoming financiers. These are the countries that specialize in postponing consumption and provide finance to everyone else. So actually, no, there's a trade imbalance that appears in the model. And so while I study specifically the role of financing frictions, there's absolutely a role also for trade frictions to contribute to this. Right. So no, that's absolutely the case.
So potentially two forces are both working.
Absolutely. So if I may add, there's currently a very vibrant and exciting research agenda in international macrofinance that is trying to really understand how the two interact. Basically, we're working towards a unified dynamic theory of the balance of payments. So I think that's a really exciting research agenda.
Right. Great. Lastly, one question for Karsten. I think sort of, I want you to, reflect on Michael mentioned earlier about China, right? China doesn't actually give much credit to consumers because 90% go into firms, right, to investment. But you seem to suggest actually, well, too much credit to consumer is bad, right? So can you two sort of reflect this a little bit more? So should China actually give more credit to consumer? If they do that, will this end up in Karsten's mention, right? That's actually bad.
Right, so I would maybe differentiate two things. I mean, the first thing very clearly is we need to think about where in the development process is a country, and we need to think about welfare versus growth in some sense, right? So, in fact, when Germany, in fact, also used to implement very kind of heavy-handed credit controls, directed credit, and the justification was that household debt or lending to households was in fact a luxury loan. It's something that is not really needed from kind of a growth or development perspective, right? So it's purely kind of a welfare thing. Now, the second thing I would highlight is that, I mean, we've learned a lot, I think, since 2007-8 in terms of the dangers, in some sense, of household debt. So, there's clearly probably some kind of trade-off, right? So, I would actually be very curious to hear Michael's view on this as well, right? So, certainly, I think the research suggests, right, that there is some kind of trade-off, but how well can that actually be implemented in practice if you wanted to encourage household lending, right? Is another question.
Yeah, China's really interesting because it shows us in pretty dramatic relief the various stages. So in the 1990s and 2000s, China was, by the end of the 70s, China had gone through 5 decades of anti-Japanese war, civil war, and Maoism, and it was probably the most underinvested economy in the world. And in a case like that, what you really want to do, the best way to boost consumption is not to boost consumption, but to pour saving into investment. And as you have rapid investment growth, that drives up productivity, which drives up wages, and in the long term, consumption goes up. The problem with that model has always been the same problem. Every country that's followed that model has run into the same problem. And that is, at some point, such a high investment growth rate closes out the gap between the investment you can productively use and the investment that you have. And in that case, what really determines investment is not more access to saving, but rather more demand. And so in theory, you should shift the provision of credit away from investment and into consumption. And Beijing has tried that many times. In fact, last March, you remember, they directed the banks significantly to increase consumer lending, and the banks did. The banks do whatever they're required to do. And by November, all of that had been backed out, partly because of a rise in non-performing loans, and partly because the Chinese they were so uncertain about their future that the only way you could get them to borrow and spend is by lowering your lending standards pretty significantly and finding, the most risk-taking parts of the economy. So they want to do that. They want to increase consumer lending. The problem in China is that low consumption is not an oversight. It's not something that just happened when nobody was watching. Low consumption is fundamental to the competitiveness of the manufacturing sector because of these transfers. And this is why we've been talking about raising consumption for, well, technically since 2007, but basically for the past 10 years with almost no effect. Because as long as you want to continue supporting the manufacturing sector, that comes at the expense of the consumption, a household income. And so you cannot both resolve low consumption and maintain strong manufacturing growth. And until they decide which one they're going to choose, they're going to be stuck with very little growth in consumption.
Great, thank you. So now let's open up. Atif? Yeah.
Thanks. There's an important premise in both what Luca said and what Michael said, that when capital goes into the US, it finances consumption expenditure or dis-saving rather than investment. And I agree with that. Empirically, that's what it looks like. So it's a defensible assumption. But another way to frame all of this is that if only we could change that. So if only we could change the financial system or maybe the incentives within the financial system. Michael, you mentioned they might go from what is profitable as opposed to what is productive. So maybe that. So I'm curious to hear both of your thoughts as to, is there something that can be done? Or do you have a micro foundation of why it is the case that when capital flows in, it tends to finance consumption expenditure as opposed to investment expenditure?
Who's that directed to?
Any one of both of you.
Well, if I can start, one possibility is that a lot of this capital is really going into liquid assets, so U.S. Treasuries, and then it depends what the government does with this money, right? Whether it uses it to direct it toward productive investment or use it to finance government expenditure or to do transfer to household, so the household will spend more in consumption. So I think, for instance, in the framework that I showed you, liquid assets play a key role because that's what we see. A lot of surplus countries do not invest in U.S. firms. They're investing in treasuries, household credit, so that's a possibility. And then, as I said, there are policies that you can put in place to try to direct credit. I know more the European case than the U.S. In Europe, for instance, there is a clear lack of public investment in basic R&D. And if you do that, you will also have a multiplier effect on private R&D. So directing some of this capital toward public R&D might be a way to direct capital inflows to private R&D. So there are policies that you can do.
I have a very simple framework for thinking about this, and that is, what's the constraint on business investment? And I would argue that the constraint in advanced economies tends mostly to be a demand constraint. So rather than worry about all these other issues, the question is, how do you boost domestic demand, right? Or how do you boost demand? And there we sort of run into a problem, because the best way globally to boost demand is to boost wages, right? This is the old Kalecki paradox, right? If we all boost wages, then total profits go up because total demand goes up. But the paradox is that if I don't boost wages and all of you boost wages, right, then I get a disproportionate share of the benefit in the increase in wages. My profits go up faster. And I think that's sort of the problem we have in the global economy. If the US or Europe were to boost wages domestically, that would be good for the global economy because global demand would go up. But who would serve that demand? And I would argue if you boost domestic wages, you're undermining your own manufacturing competitiveness. You know, when businesses say we've got to move our factories out of China, out of the US into China, otherwise we can't compete, they're not lying, right? They're not doing it to be nasty. It's literally true. It's so much cheaper to manufacture in China for a whole bunch of direct and indirect reasons. So they have to do that. So it seems to me, you know, I'm falling right back on Joan Robinson's old argument, and that is ultimately what we're likely to see, and I've been saying this for many years, is that more and more countries are going to intervene in their external accounts to protect domestic demand. That's the only way to allow them to raise wages. And ultimately, unfortunately, I think we're moving in a direction of more fractured trade, because I don't see otherwise how you benefit from, or how you increase domestic demand in a way that benefits your own companies.
Yes, Şebnem Kalemli-Özken, Brown University. Excellent panel, and this is a topic dear to my heart since we have written our paper, Why Doesn't Capital Flow from Poor to Rich Countries, from rich to poor countries, an empirical investigation now 20 years ago. The literature came a long way, but I think the problem, identification problem stays, which is what why raised. So 2 questions on this. First, Bruno. We did a very similar exercise to you, right? We have measures of culture, frictions, barriers to capital flows, and risk, and institutions. And the challenge is identify causally, right? So, and we try to find instruments for many of these variables. And what kind of work is, at the time, again, this was 20 years ago when Daron Acemoglu and co-authors were writing papers on the importance of institutions, which they ended up with the Nobel Prize for that work. So we used their instruments, and it was very successful. And, you know, so kind of I mean, both are important. Obviously, there are barriers to international capital flows, but this risk, both in terms of the policy risk, business cycle risk, but also the country risk, right? Just the investor thinking, I will not get paid back, turns out to be extremely, extremely important. And over the years, I mean, you know, this was our paper, but over the years, if you look at what happened, there's a lot of also anecdotal evidence supports that. For example, during the zero lower bound, right? During the zero lower bound, financial markets had no problem in terms of the barriers, right? I mean, countries like Turkey and Brazil, they are getting 10 billion a day. I mean, recall the debate between Ben Bernanke and Raghu Rajan, then the governor of Bank of India, how this was creating overheating in their economies, going back to Karsten's point. So to me, it's very important to think the dynamics of this, and more maybe at the firm level, when there's no return in advanced countries, clearly the barriers to international capital flows disappeared and capital did flow. But then, you know, so there's a risk-return argument here, right? And then the risk was still there in terms of country risk, but return was so high and the return is zero here. So, and now, of course, it is back. Right now, you know, we don't have that much because the return, the AI investment and the stock market is just so big. Forget the, you know, going to emerging markets and poor countries. Everybody's coming to U.S. I mean, there is now work by Andy Atkinson, Fabrizio Perry, that shows that not only that U.S. benefiting from that, Europe is also benefiting from that because, like, Europeans heavily invested in the U.S. stock market, and then they are getting a return on that because, of course, U.S. stock market is overly valued right now. So I think this dynamic dimension is very important, right? How financiers trade, return, and risk. And that of course, interacts with policy, but I think, so I want to know how you think about that in the context of your static model. And the question to Luca, I completely agree with you on the industrial policy, but the interaction with global imbalances, I have some questions. Think about Germany, right? Germany is as an important current account surplus country as China, and also suffers from manufacturing decline, very similar extent to US, where US is the current account deficit country, right? And you know, Germany didn't have industrial policy to the extent of China. So should we really think this as a combination with global imbalances, or industrial policy maybe also combined with monetary policy, and kind of with the low interest rate, we should be thinking about the firm credit allocation, right? I mean, which firms got the credit. Of course, there's still this sectoral dimension, but in that sense, how that happened more than a global, because we have this issue. So industrial policy combining maybe more with the low interest rates than less with the global imbalances. So what are your thoughts on that?
Shall I go first? First of all, thanks for the very long question. First. And first of all, let me just say that I agree with basically everything you said. All of the things you mentioned are super, super important. And my presentation did not focus on those because it's not in the model, it's not contemplated by the model. It's simply, in the paper, we decided to answer a different research question. Now, with respect to the points you made at the very end, super important, like very often, the rate of return to investment in different countries changes because, for example, of a technological breakthrough, right? Everybody's talking about AI. We've seen this massive boom in investment, in fixed investment in the US, driven by AI. So how is that in the model? The answer is that basically, in the model, there are parameters that you are basically allowed to change in order to simulate what that will do. For example, you can say in the model you can simulate a massive boost to TFP, or for example, you can write a multi-sector version of the model, simulate what happening in the A sector. We didn't do that because we wanted to focus specifically on the role of barriers to international investment, but all of that is going on inside the model 100%. So basically, that's another interesting paper that you could write with this model.
Luca, you want to?
Yeah, so if I can summarize what you said, does industrial policy necessarily lead to trade surpluses and global imbalances? And the answer is no. Because if industrial policies are done well, what they're going to do is that they're going to increase national income. In principle, consumption could rise in tandem, and so there could be no impact on the external balance. So in the paper, we called the type of industrial policy that lead to global imbalances unbalanced industrial policy, because they arise from a combination of policy that boosts the supply of the economy and compress domestic demand. Think about tight fiscal policy or financial repression or policies that keep wages low or perhaps foreign exchange reserve accumulation. And what's interesting is also that you can see this kind of policy that suppress domestic consumption as an industrial policy, because the way they work is that by suppressing domestic consumption and domestic demand, they tend to depreciate the real exchange rate and make manufacturing and tradable sector more competitive. So perhaps you mentioned Germany. So perhaps Germany was not using heavily standard industrial policy, but through especially a tight fiscal policy, it was keeping domestic wages and the exchange rate depreciated and supporting its tradable sector this way.
Okay, but I just want to add something. This is very important because still what you said, the key is this innovation externality, right? The fact that there is this extra knowledge to innovation in the tradable sector, and that externality is not internalized. That's why there's less innovation in that sector. But that goes with market size. And if you look at, again, now this year's Nobel Prize winners, actually one from Brown, Peter Howitt and Philip Aghion, the first thing they said in their interviews is they are very worried about tariffs, which is just struck down by the Supreme Court, which I think we can all be happy. But they are very worried about tariffs and this backlash against globalization, against trade, against financial globalization, because the key determinant of innovation is the market size. The more you close the economies, the less innovation is going to be there. So that's kind of complete different assumption than your assumption, which is then going to revert your results.
So here, the way it
we
works,
have more questions here.
That by depreciating the real exchange rate, you keep production costs low for the tradable sector, but you're maintaining high demand. And I'm with you that trade fragmentation might lower innovation by reducing market size.
Yeah.
All right, great. Let's have this a little bit later. Emil, okay, why don't... all right, let's raise all the questions, and you guys choose how much to respond. Emil first.
Thanks. I thought this was a fantastic panel. So this is mainly for Luca, but maybe also Michael. So suppose I propose kind of the slight twist on your model, which is that the East is poor and more capital constrained, and the rest is rich, and firms are not financing constrained. I think Michael alluded to this a few times that that seems to be an important difference. What do you think about the view that these industrial policies can help financing constrained firms sort of along the transition path as you need to build net worth and be able to invest because you don't have access to funds. It's useful. But in the narrative of these policies in many countries, I think Korea, Japan, there is also costs to the policies. And so there's kind of the story of an expiration date of the policy as well. It's kind of a policy you can use along the path, but rich countries shouldn't necessarily do it in the same way. Now, in Europe, the Draghi report, there's this discussion that maybe Europe is now, we're going to go and do lots of industrial policy and try to generate unicorns through directing credit or other kind of industrial policy. But can that really work? I mean, it seems like under the model that I laid out, perhaps not. Or what are your thoughts on kind of that twist?
Let me collect all the questions. You guys can think a little bit. But this will be the last round. Yeah. We have a few raising hands. Let's collect all the questions and then we answer in one round.
I thank you for the panel today. I think this is maybe coming more from a practitioner's perspective, but for the most past quarter century, we essentially saw that U.S. became the consumer of last resort. Effectively, basically, they were exporting a lot of dollars in returns for goods from other countries, and those dollars got recycled back into the U.S. assets in the form of portfolio investments. And Professor Pettis, this is, I guess, aligning with your idea of U.S. savings is balanced by rest of world savings. So, looking at the current environment whereby the administration is looking to unwind some of that dynamic and really kind of go through with the whole global rebalancing theme, I was wondering what you think the path of least resistance would be when it comes to getting that dynamic to unwind. So essentially, which leg of the equation would unwind first? Would it be addressing rest of world savings first by trying to convince those surplus countries to consume more and thereby saving less? Kind of they're already doing that a little bit through increased defense spending? Or is it by getting the U.S. to fix its savings first and then trying to restore manufacturing the way that they tried to do post-Plaza Accord? Or maybe you don't need to rebalance, and it's just trying to pursue the countries to switch from portfolio investments to financial or FDI. Thank you.
This is clearly a topic we have lots of interest on. Yes, there are two more there. So could you be a little bit brief?
Thank you very much. My name is Niels Graham. I'm a first-year MPA. Previously, I did a lot of industrial policy research on behalf of Congress. And I guess just a question, it seems like a lot of the mechanisms that you're focusing on have a relatively long time horizon to impact. And I think a lot of the things that the U.S. at least is most interested in is getting this industrial policy, getting these sort of investments in a very fast way. And as a result, we're intervening in very specific sectors, picking winners and so forth. I'm just wondering if you could react to see if your models suggest anything along this more agnostic approach, but still operating on a time horizon that could really see impact in the next 3-4 years.
There's another one. Yeah, here. Yeah, here. Here.
Thank you. All of your models mention a sort of equilibrium that is caused by certain constraints and that is potentially unfavorable for both sides. How did these equilibria respond in times of extreme supply chain crises, whether that be 1973 OPEC or what we've seen more recently, 21, 22? Do these equilibria fundamentally change in the long run, or did they solely change in the short run, or did they not respond at all?
Okay, great. All right, so let's. This will be our last round. So maybe Michael, you can answer whichever you want.
Lots of really good questions. I would like to take a crack at all of them, but there's no way I can do that. What I will say, maybe a little bit shocking. I think a few years ago it was very shocking. I think it's becoming less and less shocking now. But to the question is what the U.S. can do to address the imbalances. If you believe, as I do, that the transmission mechanism is mainly through the capital account, then the solution is probably through, or the most efficient solution is probably also through the capital account. And I always remind people that back at Bretton Woods, when Keynes and Harry Dexter White disagreed on so much, White always won because he represented the U.S. In many cases, Keynes should have won because I think he was right. But one thing that both of them agreed is that it was very hard to justify the unfettered flow of capital. the theory behind unfettered capital flows is that capital flows from capital-rich countries to productive investment in capital-poor countries. Now, we all know that that's a joke. That's not at all what happens. And as a former bond trader, I can tell you, when I made a decision to buy Mexican government bonds, it was never because I wanted to see that money employed in a factory in Mexico. It was because I thought in the next 3 to 4 months, the interest differential worked in my favor. But the fact is that capital flow, the economy has to respond to capital flow imbalances. So whatever the cause of the imbalances, the economy has to respond. So my favorite solution is for countries, including the United States, to impose a kind of Tobin tax on all capital inflows. I don't think Wall Street will hate it, but I don't think we need a world of unfettered capital flows.
Great, thanks, Michael. So maybe we go from this side. Karsten, you want to share any thoughts you have?
Sure. I would just say a word on the kind of lead time for industrial policy in some sense, right? So I think it's just in the nature of these types of policies that they take time to really show up kind of in a macro aggregate. But kind of if you think about the immediate effect that they have, I mean, think about employment outcomes, for example. If today, right, I'm a manufacturer and now I have access to more, say, support by the U.S. Export-Import Bank, right? I mean, it's pretty immediate, right? Now I know I can actually, send an export good to some other country because now this is kind of a profitable transaction. Otherwise, it may have been too risky, or my bank kind of turned me down, didn't want to finance this transaction, right? That's pretty immediate in terms of my own capacity, right? So I think it really depends on policy design as so many things. It's not kind of that every outcome, you have a massive lead time when you're thinking about industrial policies.
Thanks.
Okay,
Luca?
just very quickly on Emil's point, so do the same type of industrial policy work for developing catch-up economies to advanced economies? Probably not. Probably if you are catching up with the technological frontier, it's easy just to subsidize high-tech sector and make them copy discoveries made themselves well and growth. If you are an advanced innovative economy, this simple receipt might not work, so what should the rest of the world do? It's a tough question. So I know the European case a little bit better, and there are many solutions on the table, probably completing the single market to give more demand to European firms. It's a good idea. I think in Europe we have a lack of public basic R&D and public-private R&D partnership, which might work. But there is a lot of research to be done to understand which kind of industrial policy work in frontier advanced economies.
Bruno?
I may perhaps take the last question about shocks and how those affect equilibrium in the long term and in the short term. So going back 1 second to my presentation, I think there's two big takeaways from this research agenda on spatial international finance. Is one that countries nowadays compete in the global markets for capital, okay? And two, countries can do a lot of things outside of capital account management, that basically a lot of things about their institutions and their macroeconomic environment affect basically their ability to compete, okay? Now, going back to the shocks issue, so in periods of heightened stress, I think I want to reconnect to what Ken Rogoff said yesterday in the keynote. He basically mentioned how the U.S. dollar is being weaponized to pursue geopolitical ends. So that basically has a cost because it increases economic policy uncertainty. It changes. It can potentially, over long periods of time, change the international investor perception of the United States. So there's a great question, which is, how persistent of a shock is the current, uncertainty about U.S. Policy. So very often in economics, we work with dynamic models. And what a shock does in the short term and in the long term depends on how persistent that shock is. Whether it's very different to raise interest rates for 1 year or to raise them persistently for 5 or 10 years. Those are two completely different things. And so going back to U.S. competitiveness, international financial market, a lot of basically the ability of the United States to retain its ability to be, the financial supermarket of the world depends on for how long this period of policy uncertainty will persist.
Great. Thank you. So I think this is a great topic. Everyone has lots of thinking and opinion on this. So we can spend another 2 hours on this, but maybe Atif, you should run another conference at some point on this. So let me thank Michael for a fantastic keynote speech, sharing your deep thoughts, and for all the panelists for sharing your excellent work. So we should continue another time. Thank you.